would Bitcoin be selling out massive conferences in Las Vegas, and would it be worth over $100,000 per coin? Most people would say no. In fact, many critics kept saying that it's just a zero-rate phenomenon. It's some bubble that's going to go away as soon as the Fed gets any sort of hawkish in them. But what we've seen over the past several years is the Fed got about as hawkish as they could get. They even broke some banks in the process, and yet gold and Bitcoin both soared anyway because something changed.
Hey guys, welcome to Everyday Finance. The global economy is going through a big structural change, which is being marked by rising debt, persistent inflation, and central banks that aren't as good at their jobs. Because of years of deficit spending and artificially low interest rates, long-term risks are now real and not just hypothetical. Lyn Alden, a macro strategist, has become a leading voice in this changing landscape by giving clear explanations of the forces that are guiding the current economic path. In her famous phrase, "Nothing stops this train," Alden summed up her main point. The world's financial system is stuck on a path marked by fiscal dominance, unsustainable debt obligations, and a need for constant infusions of cash. Alden says that traditional tools like raising interest rates, cutting the deficit, or changing the rules on entitlements are no longer politically possible. She says that central banks aren't really independent anymore, because any real interest rate hikes would make it much more expensive to service government debt, especially after the COVID-19 debt explosion. This creates a feedback loop that makes people less likely to take strong steps to fight inflation. This leads to financial repression, where savers get negative real returns. Alden says that this is not a short-term phase, but a fundamental change in the way the economy works. At the recent Bitcoin 2025 conference, Alden talked about why this fiscal path seems unstoppable and why investors should think about protecting their money with hard assets like Bitcoin and gold. As we go over the most important parts of her talk, don't forget to like, subscribe, and turn on notifications for more in-depth market analysis.
And so the inter-exchange between what's going on in Bitcoin and what's going on in dollar land really matters for things like the exchange rate, things for the economy, investing in general. And so we'll start now. We'll go into these kind of pretty concise slides. Some of them will be simple slides. Some of them will be a little bit more complex, but I'll walk you through the parts that really matter. So this chart here shows two lines. One is the unemployment rate, and one is federal deficits as a percentage of GDP. And this goes back many decades. And as you can see from the slides, there's always been very good correlation between them. During recessions, unemployment goes up, the federal deficits go up, and during better times, unemployment is low and federal deficits are low. The one brief exception, if you can kind of squint and see it on the chart, is 1960s. That's when we had the Vietnam War. So there's a little bit of an exception, but other than that, these are almost the same line. But what you'll see on the right-hand side of the chart, and I circled it in green, is over the past several years, ever since around 2017, we've had a decoupling. We've had shrinking unemployment, we've had low unemployment levels, and yet the deficit has blown out to 6 or 7%. Even before and after the pandemic, this was already happening. Obviously, it went into overdrive during the pandemic, but we're kind of in this new world now. I'm not the first person to talk about the deficits, but I am trying to bring attention to what's going on now that was not going on for many decades. We're entering kind of a new era. So that's what the deficit is. But the second main question is, why does it matter? Why are we talking about it here at a Bitcoin conference? And the short reason is because it matters for asset prices, especially anything scarce. So this chart shows in the gold line is the price of gold, and the dark line, the black line, is real interest rates. And again, we've historically seen that there's been a very strong correlation between these two things. And so for those that don't know what I mean by real interest rates, this one is specifically the 10-year Treasury yield minus CPI inflation. And the reason these two charts, gold and real Treasury rates, are so worth comparing is because they're the two primary reserve assets globally. They're the ones that compete with each other at that scale. And gold, of course, is pretty scarce. The supply grows by an estimated 1 to 2% per year, but you don't get paid any yield to own it. If anything, you incur an expense for storing it. Whereas treasury yields, dollars and treasuries, they grow at a much faster supply growth, but then you get paid this yield to own them. And during periods where the yield is rather high compared to measured levels of inflation, some of the investors that might otherwise buy gold get enticed to come back to the dollar and the treasury system. But then during periods of time where the yields are not high enough compared to inflation, many investors flock to gold. They basically say, if I'm not going to get paid anything on my treasuries, why would I own treasuries that are way more abundant than gold? And historically, this has been a very strong correlation. High real rates means higher gold prices. And on this chart, the real rate is inverted. So lower means higher real rates. And again, as you've seen over the past several years, this one in particular starting around 2022, we've had a complete decoupling in the price of gold and real rates. There's something new is happening here in this kind of fiscally dominant environment. And of course, this is relevant for Bitcoin. A lot of people, if you would have said 5 years ago, if interest rates are 4 or 5%, would Bitcoin be selling out massive conferences in Las Vegas, and would it be worth over $100,000 per coin? Most people would say no. In fact, many critics kept saying that it's just a zero-rate phenomenon. It's some bubble that's going to go away as soon as the Fed gets any sort of hawkish in them. But what we've seen over the past several years is the Fed got about as hawkish as they could get. They even broke some banks in the process, and yet gold and Bitcoin both soared anyway because something changed.
Lyn Alden, a famous macro strategist, points out a major change in the Federal Reserve's capacity to run the economy. She says that traditional monetary policy tools, especially changes in interest rates, no longer work as they should in a world with a lot of debt. By raising or lowering rates, the Fed was able to control credit cycles and inflation for many years. But that framework was made when the federal debt was low and most money was made in the private sector. Alden says that rate hikes make fiscal imbalances worse instead of better, now that the U.S. federal debt is higher than 100% of GDP. Instead of slowing down the economy, higher rates are speeding it up by making the government pay a lot more in interest, which increases deficits and makes more cash flow needed. As Alden puts it, this is an economic wonderland, where the normal rules have been turned upside down. The tools that were used to put on the brakes are now being used to speed up the car. This change makes policymakers' choices smaller and supports Alden's idea that nothing stops this train. A system driven by fiscal dominance, trapped by its own obligations, and unable to use past mechanisms to regain control. Alden says that this structural imbalance means that central banks will no longer be able to make their own decisions and that old solutions will no longer work in a new era. Stay tuned for more information as we go back to her in-depth presentation at the Bitcoin 2025 conference. Also, don't forget to like, subscribe, and turn on notifications for more financial news.
So the blue line on these charts is private sector year-over-year debt growth. So that's bank loans and that's corporate bonds, that type of thing. The red line is federal debt growth. So you have private markets and public markets. The pane on the left is 1955 to 1990, and the pane on the right is 1990 to the present. So this is a 70-year history. And if you look at the left side, for the most part, the blue line, private sector debt growth, was going up at a faster rate in any given year than public sector debt growth. And there are rather few exceptions that occur around recessions, and I mark those in yellow on the charts. And those are pretty few and far between. During recessions, the deficits would go up, bank lending would go down, and then we move past that. What you see in the chart on the right is that ever since the 2008 global financial crisis, and especially ever since in recent years, we've been in this period of time where federal debt growth is consistently going up at a faster rate than private sector debt growth. And I highlighted again in those little green boxes, if you can see them on the right, that even outside of recessions, this is still the case. So this was happening before the pandemic, And after the dust settled, after all the money printing, it's still happening now. And the reason this turning point really matters is because when we look at what the Fed, what their tool is to control credit growth, it's mainly interest rates. If they want to slow down the economy, slow down credit growth, and try to slow down inflation, they jack up interest rates to try to make borrowing less attractive. On the other hand, if they want to accelerate things, they tend to lower interest rates. The problem is that, many decades ago, when federal debt was low and most of the money creation was coming from private sector, whenever they raised interest rates, they would slow credit growth. They would slow the private sector faster than they would blow out fiscal deficits. The problem now is that now that they have over 100% of GDP, which only happened in recent years, when they raise interest rates, they ironically increase the federal deficit at a faster pace than they slow down private sector credit growth. Basically what that means is they don't have brakes anymore. The train, nothing stops this train because there's no brakes attached to it anymore. Or another way of putting it is the brakes are heavily impaired. We've kind of gone through the looking glass. We're in Wonderland now, where the rules that worked for the majority of this time frame now work backwards. They don't really have a way to slow down total credit growth in the system. And that's a new phenomenon. So for the remainder of this talk, I'll just go over a few slides of why this is so unstoppable. Why can't just a couple people get together and figure this out? Why is this so entrenched? Why is it that I'm confident to say that nothing stops this fiscal train, even regardless of election outcomes? I was saying it before the election, I was saying it after the election, because it doesn't really matter, nothing stops it. And so on this chart, we have, this is a pretty simple chart. The blue line is 10-year interest rates, 10-year Treasury interest rates. And the red line, we have debt to GDP, federal debt to GDP. And, back in the 1980s, you had very low debt levels and you had very high interest rates. And we've gone on this, 4 to 5 year decade journey of ever higher debt levels. But it's been offset by this structurally declining interest rate. And what that means, for example, if you double your debt but you cut your interest rates in half, your interest expense is still manageable. So for this whole 40-plus year period, interest expense was actually pretty manageable. But what happened is that eventually we hit zero. Just math kind of reasserted itself. And so now we're in an environment where the first time in decades, interest rates are not going structurally down anymore, and debt levels are still very, very high. They're the highest that they've ever been since the 1940s. And so interest expense is actually becoming a very meaningful part of the federal expense for the first time ever, and there's no easy way to get that under control. If they cut interest rates super low, then everybody wants to get into scarce assets. But if they keep interest rates high, they keep blowing out the federal deficit because we're kind of, like I said, we're kind of in Wonderland now. One of my last slides is to emphasize the Ponzi nature of the system. So even aside from current issues related to demographics and debt levels, basically the way the system's constructed, and by the system I mean central banking with fractional reserve banking built on top of it, the whole fiat system we've been kind of operating under for over a century, it relies on constant growth. It's like a shark that can't stop swimming, otherwise it drowns, ironically. It's a system that has to keep increasing. And so on this chart, the top line is total debt in the system, in the US system. So that's public debt and private debt combined, and it's actually over $100 trillion for the first time. And the bottom line is the monetary base. And what we see is that for the entire period of this chart, so this goes, I believe, from 1966 until 2025, the entire period of this chart, total debt never went down except for one very brief exception, and that was 2008. And it went down by about 1%, total debt in the system. And what they did was they rapidly increased the monetary base from $1 trillion to right now about $6 trillion. It was so impossible for them to let even a tiny amount of deleveraging occur that they kept the party going. And specifically back in that time, so if we do the math a little bit, in 2008, the total debt in the system was in the ballpark of $50 trillion. So it's about half as big as it is now. And they were on a monetary base of about $1 trillion. So the system is levered 50 to 1. That's the type of leverage you see in crypto degen derivatives contracts. It was it was 50 to 1 leverage across the economy. And specifically, they hit zero interest rates. So they couldn't keep propping up the private sector debt bubble. And instead, they rotated to the federal level. And so that kind of shows how sensitive the system is. As you've kind of gone forward, we're now more in the public sector debt growth. I actually looked at the data that goes back even longer than this chart, going back about 110 years. And there were only 4 other years where the total debt level ever went down nominally. And that was during the Great Depression. So 1930 through 1934 was the only other period beside 2008 on the chart where it went down. So 5 years out of over 110 years of data is their tolerance level for ever letting that Ponzi unravel. And that's just kind of the system, that's the math that we find ourselves operating in. And that's the big contrast that we have to Bitcoin.
Lyn Alden's famous phrase, "Nothing stops this train," is a sobering diagnosis and strategic warning for investors. Alden believes inflation control, debt reduction, and monetary normalization are no longer achievable in the U.S. permanent fiscal deficits. Rising debt monetization and long-term currency debasement are structurally locked in. She means a system driven by political inertia, structural deficits, and the inability to implement meaningful fiscal reform, not growth or progress. Alden's analysis avoids dire predictions of collapse or hyperinflation. Her warning is more persistent. Deficits at 7% of GDP or higher erode monetary integrity, regardless of economic cycle or political party. She sees this as a grinding, compounding trajectory with no incentives to slow down. Politicians are unlikely to raise taxes or cut spending, and voters don't want it. Alden claims that the fiat system is designed to expand. Printing more currency is a feature used to solve problems. Alden advises a strategic shift away from conventional assets that depend on low inflation and monetary discipline. In a world of structurally soft money, she values hard assets like Bitcoin, gold, and productive real assets that resist debasement and store value. Bitcoin is transparent, scarce, and disciplined, unlike fiat. Alden believes Bitcoin is a form of financial self-defense because it requires voluntary deleveraging and scarcity, unlike fiat systems. Alden predicts large fiscal deficits and no political will to change course. According to her, the train is not only speeding, but also unstoppable because the brakes no longer work and few are motivated to pull them. In this environment, prudent investors must seek protection in non-inflatable assets. She concludes that Bitcoin isn't a gamble, but a necessity in a system designed to grow continuously. Stay tuned for more on Alden's Bitcoin 2025 presentation, and like, subscribe, and share if you liked this analysis.